Okay, thanks everyone for reading through those disclosures. As I said, my name is Natalie Beckett and I'm going to be your moderator this afternoon for today's free educational webinar. We are happy to host Todd, aka Bubba Horwitz, and he's going to be talking with you guys about day trading futures. We also have Andrew Aronson with us. He's over here part of the team and he has been with us for many years and he's going to do a little brief intro for Bubba. Andy, are you there?
I sure am, Natalie. Thanks for having us again.
It's my pleasure. Thanks for being here. Why don't you do a little brief intro for us? Tell us about Bubba, and we'll get going. I know he's on the line, ready to go.
Bubba, you there? You ready to go?
I can't hear you.
Okay, I'm sure. I'm sure. Now, as usual, we're happy to have Bubba back with us. He seems like he does this every 4 to 6 weeks, and you guys are in for a treat today. I see a lot of people that have been here before and a lot of people that haven't. So what I would ask you to do, if you have questions, just put them on the screen there, and I'll get to them at the end. And I'll let Bubba take it from here. Bubba, give him a little intro on yourself, and if there's any questions, I'll be interrupting you if that's all right.
That's always all right with me. I love to be interrupted. And hold on, let me just find my right screen. There we go. I think you should see my screen now. So what's up, everybody? Welcome aboard. Of course, we're going to talk about part-time day trading futures today. It's always great to be a part of the avant-garde team and share some knowledge and share some things that we like to do. So let us begin. The greatest barrier to success is the fear of failure. And of course, we've all been taught that futures are scary and they're real risky. And the fact of the matter is they're actually not any more risky than anything else if they're traded properly. And again, success is not given, it is earned. In the meantime, before I can actually get started, I have to show you the disclaimer of my own. So go ahead and take a read of that. I'll give you about 10 seconds because that's about all it should take. And you understand there's risk and futures and options and everything have risk. So let us move on forward. Emotions, one of the biggest things that all traders in any walk, either whether you're an investor, you're a futures trader, an option trader, whatever you're trading, it always comes down to emotions, and that's usually is the doom for most. And of course, as we like to say, if you remember trading places, fear, that's the other guy's problem. Okay, and again, we don't want to be afraid. We want to learn to understand all the things that are made up into the components of trading, whatever we're trading. But in today's case, we're going to talk about futures. And of course, just a quick introduction of myself. I've been doing this for 39 years. I've been a member of one of the 3 exchanges in Chicago. For every one of those 39 years, I still am currently a member of the Chicago Board of Trade. I founded Bubba Trading. I'm the author of 2 books, Guide to Weekly Options and Guide to Trading Options. I'm a regular contributor to Fox, CNBC, Kitco, and others. And also, I'm one of the original market makers in the SPX, which was one of the big trades between the SPX and the S&P. Now, before we get started, I want you to ask yourself these 2 questions. Who wouldn't like the opportunity to trade when they want? Who wouldn't want to get the edge on the market? Okay, those are 2 things I'm going to think about, and we're going to come back to them when we finish. Now, today we're going to talk about what is a futures contract, why trade futures, the benefits of, speculators, the zone, competitive edge, probability, the strategy, margin, and then we'll take all your questions as always. Now, trading itself, whatever you're trading, is always a game of skill, but it never comes more into play than the trading of futures. If you're a gin player, a backgammon player, a bridge player, or a poker player, those are all games that the better player is going to win over time. Okay, now we all have to understand that there is no guarantee of every trade is going to be a winner because that would be foolish. We know that we have to have money management that goes along with trading. So if you take the proper skill and the proper management of your capital, then you can always be in the game, which would then allow you to get in the edge on the futures market when you're trading it, because there are built-in edges if you understand exactly what's going on within the market. Now, what is a futures contract? It's a legal agreement. Okay, you are committing to buying something or selling something. Okay, now in real terms, you're committing to the entire contract versus an option. You're only committing to the premium that you pay. Here, there is no premium. You are committing to either buy or sell the entire contract. However, we know that we have the right to exit at any time we choose. So we're really not fully committed to that contract. But when we do it, that is what you are experiencing is either if you buy an S&P, the total value is 135,000 today. Okay, if you buy it, you have 135,000. If you sell it, it's 135,000. That's what you look at when you're trading. So that is a futures contract. It's an actual agreement or a contract for the entire contract. Now, many futures, commodities, and other things that we've seen is you see from the movie Trading Places. You know, I make a lot of reference to that because a lot of that was very true. But we have commodities, we've got financial futures, we've got bonds, we've got soft commodities like coffee, cotton. So you can trade any of it. And the methods that we use are exactly the same no matter what the product is. We don't care about other things. So just know that what we're really trading is derivatives, okay? And there are many different derivative products that are out there. Futures, okay? There's forwards, futures, options, swaps. We're only concerned about futures. Now, a future or a derivative is derived directly from something, okay? So futures, you get a lot of leverage, okay? And not that we want you to take over leverage. We do not, okay? We want you to understand what the leverage is and the benefits that you receive from trading futures, okay? The futures markets are extremely liquid. They're more liquid than any other market as long as you're trading in the right futures products. But you'll never find a more liquid product. Commissions and execution costs are extremely low. In fact, you can get very low, and they will be less expensive than anything else you'll ever trade. So not only you get the leverage that comes along with it, but you get a lower execution cost. Speculators can make money and fast. I don't like that really fast money. I should probably change the wording there. But you can make money more consistent throughout this with very little exposure and not be exposed to some of the things that happen in markets when you see volatility collapses and things like that. Futures markets are more fair and efficient, okay, because they are only driven by the futures market. They are only driven by the price discovery model. And short selling is legal. You can short sell anything you want or buy anything you want. Why trade futures? Well, there are speculation traders, which is what we are. In this particular webinar, we are talking about speculation. Okay, we're talking about just like buying an option or buying a stock. We're speculating that the price will go up or down, whichever that we decide. But many use futures for hedging. Okay, hedging is a very big part of the industry, and people actually can hedge their equity portfolios. If you have a big enough portfolio, you would use futures as part of that hedge. Those of you who've seen my hedging course know that you can use the instrument. Why? Because the futures are directly related to the underlying, which is the SPX or the SPY. All those products are directly related. They will move lockstep together, okay? And futures do provide leverage. Again, we don't like to over leverage, but we want the ability to trade in and out of a market without having to come up with the cash and get some of these other big things that happen, which we'll talk about right now. Now, the benefits of futures are flexible leverage, liquidity and efficient execution, virtually 24-hour markets. Now, that's also a little bit of a misnomer. 24-hour markets, like tonight, I would suspect there might be some trading action tonight with the election, okay? But normally, unless there's something crazy going on in the world, the markets are not very liquid past 5 o'clock Eastern, okay? So from 5 o'clock Eastern until probably midnight, they're not very liquid. When the world markets start opening up, like the DAX opens up and then the FTSE, then you start to see some more liquidity again. But generally, we trade pretty much market hours. Now, if you're in other parts of the world, what we learn and futures are all the same. So if you're in the area where you can trade the DAX, or you can trade the FTSE, or you can trade the Nike, then they're all the same. So everything really comes back down to the same thing. You can buy or sell in any order. You've got lower account minimums because we don't run into a lot of the other issues. There's no interest charges or borrowing fees. You have an unbiased execution. Futures have a favorable tax treatment and ease of reporting. There's no broker or counterparty risk. So you've got a lot of things that now give you the benefit and the reasons why you would want to look into the futures market. Now, futures are a true price discovery market, okay? Now, any of you have heard me talk before, you know, I hate stuff that gets manipulated. I like true price discovery. I like when asset classes price themselves. And that's what's happening in the futures market. They're not driven by supply and demand. They are driven by price discovery. That is when a buyer and seller meet to exchange wealth, that is known as price discovery. So just a quick example, if you went to a flea market and a guy was selling a watch and he said, how much is the watch? He says $20. You say, I'll give you 10. He says 18. You say 12. He says 15. You say done. That's price discovery. Price discovery took place at $15. And that's how these markets trade every day, all the time. Now, why day trading futures is the best option for an active or a passive trader? The first thing is they move directly in tandem with the underlying asset. So there is none of this exploding volatility. There's nothing where you're paying too much premium. You're paying raw cost. Okay, they move directly in tandem. The SPX goes down, the S&P goes down. The SPX goes up, the S&P goes down, goes up as well. Futures have no restrictions on short selling. This is a big one for many, as the FINRA's pattern day trading rule does not apply. Okay, so with an account, with a smaller account, let's say 5,000, you can trade as much as you want during that day. You can trade 10 times, 5 times, 1 time, or 100 times. Okay, you can't over margin that period of time, but at any one time you could be trading. So you don't have to wait for your money to clear. You don't have the Reg T issues that come into play. You have everything that's pure. And again, new day starts, you start over. So it's like opening your own business without any restrictions. Day traders can make use of lower initial margins for futures trading. Now, some brokers offer as low as $1,500 to $1,000 day trading margin, which again, that's something that you can look at, because again, now if you're trading the mini S&P, normal margin that is $6,000, but if you're just day trading it, okay, you can trade, let's say, for a $1,500 margin, right? Whereas if you were buying the equivalent, which would be 500 shares of the spiders, you would need 62,000, because you'd need 50%. You get 2-to-1 margin during the day, and then you'd have to wait for the stock to clear, so you'd have to go back into Reg T. Whereas you can accomplish, excuse me, you can accomplish that same goal with the future. Okay, be in and out and not have any of these other restrictions that go along with it. Now, speculators, which again is what we're talking about today, we are looking at a market and we're using some of the tools that are in the market, whether or not we're trying to trade with a trend, whether we're using a blow-off pattern, whatever we're trying to do, we are speculating on what the next move is going to be. And if you watched the markets today, they were pretty crazy. They seemed to be pricing in a potential red wave based on the market action that we saw today. But you had some very big swings in the market today. And I think it was interesting when you look at, for example, you look at the NASDAQ future. You had a straight up move right off the opening, and then about midday you had a straight down move, and then at the end of the day you had a straight up move. These are all patterns that can be taken advantage of if you understand the pattern in the market. And these are the patterns that speculators are looking at over and over again, and most don't understand it. And when we get into the phases of the market, we will talk about what those mean. Now we talk about the trading zone. Okay, so what we're looking for, okay, first of all, is the setup. Okay, now we have certain setups that we're going to always look for. What are the market conditions? Now I thought today, for example, was going to be very slow, and I recommended that inexperienced traders not trade today, because I assumed it would be whippy, and it was very slow from a volume standpoint. But the biggest key, besides the setup and the conditions, are really the third option, which is the personal mindset. Okay, if you're going to get emotional about trading, it's very challenging. You cannot let your emotions get in the way. You cannot let the plus minus get in the way. You must sit and focus like in any other trade. Okay, if you're going to let that get in your way, you're going to create more losers than you're going to create winners. And real problem comes in that your losers are going to be too big. We already know that if we can hit 65% of the time, but if our 35% losers are much bigger than the 65% winners, we're not in very good shape. So again, it comes back into that personal mindset. And what we always like to say is, don't trade without the edge. If you don't have the competitive edge, don't compete. Now, if we look at probability, okay, day trading versus poker, for example. And I use poker a lot for A, because I played for a living for a while, and B, because it is a very systematic game that really directly relates to what we're doing when we're trading. You have to wait it out. You can't trade every card. You can't play every hand. You have to wait it out. You have to have enough patience to wait for the pattern that you are looking for, okay? You have to wait for the right opportunities. Now, when we do day trading, what we do is we speed up time, okay? We bring down time into a much faster period. So, for example, I will do a lot of trading on 4 minutes. So I'm changing the dynamics of a daily chart to a 4-minute chart. Now, when we look at charts, all charts are the same. All patterns repeat themselves. The shortest time frame always has to resolve itself back to the longest time frame to show what the true trend is. But the reason we speed up time is because if we want to day trade, we need to be able to create more opportunities. So if we believe in the probability, which is correct, then all these patterns will repeat themselves. So if I'm looking for an opportunity, I want to look at something that I can trade for the next 10 minutes and take benefit out of versus having to hold something for days, weeks, or months. And that's why you do this. So the objective of day trading is not to carry positions overnight, not to take the overnight risk, but to put yourself in a position, whether you have an hour a day, whether you have 2 hours a day. You know, again, I do not encourage anybody to sit in front of a screen all day. I encourage anybody to trade for an hour, 2 hours when you have time, but you have to have the ability to say, okay, I'm going to play the probability model and I'm going to wait for these patterns to appear. And if you do all that, then you have an outstanding chance to be successful in the day trading world. And again, you get to trade at your own convenience, your own time. And of course, if you use my method of 4 minutes, that gives me, on one product, 4 minutes gives me 15 opportunities an hour to potentially make a trade. So if I can go from one and watch 4 products, okay, which is not that hard, okay, because I'm only looking for one pattern, so I can look at 4 charts at once, which I'm going to just bring this over real quick and show you what I'm talking about. This is kind of what I watch all day, with the exception of Devon Energy, because that had earnings, but I would be watching these 4 products, and I'm not watching them directly. I'm waiting for the signal that I see that indicates what I'm going to day trade, okay? So what you get is you can get 60 potential opportunities an hour. Now, again, some days you'll get more than others, and that's it. There is no automatic, like you're going to get 2 trades an hour. Some hours you get 5, some you can get none. There's going to be days you won't trade. But again, being prepared, okay? And again, it goes back to playing the probability model. Now, good traders will focus on capital preservation and risk management, okay? Limit losses. Set a stop order. We use a stop in our day trading method. We use a stop on every trade, without exception. Okay. Those who run into trouble are those who decide that they are smarter or can outsmart the market. Okay. Understand how to use margin correctly. Do not overtrade. Don't become emotional. Remember Gordon Gekko? Don't get emotional over stocks. Don't get emotional. Okay, again, emotions are a losing strategy. In fact, we take advantage of those that are emotional. That's what our methods are based on, is the taking advantage of the emotions of others. And of all things, keep a trading journal, okay? Because you need to sometimes go back and look at some of your trades to say, this was a good trade that I just lost money on. This was a bad trade, but I got lucky. For whatever reason, but you want to understand how the markets move, because you should be able to recognize these patterns in a heartbeat. Luck is not a strategy. Okay. Now, developing a strategy, you can be a trend trader, okay, which does not work well for day trading. Okay. You can be a swing trader, which is, and by its own terms, is not a day trade method. You can gamble, which doesn't work too often. You can try to trade momentum. I personally never liked I was never a good momentum trader. I never liked it. I always felt there was too much risk, and I was always getting the end of it. You can counter trend, or you can trade one specific pattern. What we do is we blend the counter trend with one specific pattern, because that one specific pattern will create a counter trend trade. Okay, so that's what we're working at. The other ones are more longer term strategies. Day trading is speculation, securities, specifically buying and selling financial instruments with the same trading day. Okay, and that's, again, We want to be within the same trading day because we don't want to have these overnight margin calls. We want to be able to leverage up our small capital and be able to trade more often, creating bigger capital. Swing trading, again, by its very nature, is longer term. You're swinging over a day, a week, a month. Again, that depends on what your pattern set up. But when you look at a chart, which goes back to when I said all charts are the same, here's a day trading chart and a swing trading chart, because they are exactly the same from a technical aspect. And what we're trading is we're trading based on technical analysis. Okay? It has nothing to do with the election. It has nothing to do with the fundamentals of the market. We're trading a technical pattern because technical analysis always gives the trader the best edge and the best opportunity to compete. And again, the difference is between is a day trader can trade with $5,000 and get the same benefits that a swing trader can get, but the minute the clock ticks past 5 o'clock Eastern, if you're not out of your position, then the overnight margin kicks in, and that's when you run into a problem. Don't confuse strategies. Don't change midstream. Don't turn a day trade into a swing trade. I would say this is one of the worst and one of the biggest problems for most traders, okay? That's why I urge you in this account that you keep a smaller balance so that you can't do that, okay? This is one of the biggest problems. You go, well, I'll wait till tomorrow. Well, guess what happens? The markets get clobbered again, or they go straight, whichever side you're on, they go the wrong way. The biggest key you can learn from this is to take your losses. Okay, that's what you do. You need to take your losses when they come, because we know there's going to be losses. Now, margins, again, we don't want margin calls. Day trading will not create margin calls. Okay, margin calls are margin is something that is determined by the exchange. Okay, it's not a government regulation. It's the exchanges, and what they're doing is they're setting up margin so that you are guaranteed to get paid. If you are on the right side of the market, you get paid. That's why you use regulated exchanges versus if you know some of the Forex markets that are not traded through regulated exchanges. When the Swiss franc went kablooey about 8 years ago, a lot of those exchanges closed. Nobody got their money. Okay, so that's good. That's what margin is good faith money that is put up on both sides of the trade so that the exchange can guarantee payment to whoever makes money on their trades. But again, we do not want to carry trades overnight. I mean, I do myself, but again, this is not what this is about. This is to be able to take a smaller account and trade it and be in the market and be out by the end of the day. It's like owning your own business, putting your key in the door in the morning with no inventory and closing at night with no inventory and making money during the day. Now, one of the key things that we look at are what we call the phases of the market. Okay, and this goes back to everything I do is based off of this. Okay, now the phases of the market, okay, are very simple. Okay, the first phase of any market is that all markets are born out of consolidation or congestion. Okay, that is when the markets themselves, okay, cannot make up their mind. Buyers and sellers, you have buyers push it up to the upside, sellers come in and push it down, new money comes and pushes it up, new money pushes it down, and you're making a series of what they call double tops and double bottoms. Okay, eventually, congestion or consolidation will end, and the market will break out. Okay, and in this case, the market broke to the downside. So now we have a trend, and in the trend, we are seeing lower highs and lower lows because we're going down. If we were going up, it would be higher highs and higher lows. So you then come to the trend. So if congestion is the birth of the market, then the breakout is the life or lifespan of the market, and eventually the markets will usually have what they call a blow-off, which would be the death of the market. And right here, as it turns out, is a blow-off to the downside. Okay, you can see by the heavy volume, okay, the heavy selling, and of course, this is a potential buying opportunity. This is the pattern that we're looking for. Either if we're on the short side of the market, okay, if the trend is going lower, we're looking for that big sell-off to the downside, and then the opportunity to step in and buy here, okay, because that's how we trade it. And of course, obviously, this would have turned out to be a winner. I didn't know it when we looked at it, but of course, this turned out to be a winning trade. But that's not the point. The point is we're looking for this. This is when we call this the final puke. Okay, this is when the investor, the trader, whatever, finally puked it out, couldn't take it anymore, and that's where we want to take advantage. That's how we create the edge. Okay, now this is not enough volume, but right now we're seeing, okay, in the aftermarket, a little bit of a blow off to the upside. So I'd look at that, but right now we're talking on a webinar. But that's, you can take a look at the Aussie dollar later and see how it resolves itself. But I would guess there'll be some little sell off in there at some point. Okay, the Duke and Duke brokerage, from another reference to Trading Places, is your trading process focused on long or short time frame? This process is on a, I use 3, 4, or 5 minutes, whatever fits your style better. We use we use two time frames, one to find the pattern, the second to signal the trade. So I use a 4-minute and a 1-minute. The first to find the trade, the second to go ahead and make the trade. You use technical or fundamental analysis or both. I use no fundamental analysis. I could care less what the fundamentals are. I'm only concerned in part-time day trading, a long-term capital gain is 4 to 8 minutes. If you're in a trade longer than 8 minutes, you're making a lot of money. Okay. You have to have a special knowledge of futures market that gives you an added advantage? No. You have to understand the blow-off pattern. You have to understand the phases of the market. Other than that, you don't have to have any special knowledge. You always use a well-defined trading plan that you'll follow without fail. Well, you better. Okay. Again, failure comes with most traders and most investors because they have no plan. Does your trading recognize the market trend? We don't care about the market trend. Does your trading process work well in up and down markets? It works equally as well. I would say it probably has a bigger win rate when there's a blow-off to the upside, from a profit standpoint, but it works well in both. It works exactly the same because basically you're turning the chart upside down. You have a proven trading process that applies to trading futures. Actually, this process applies to everything. The reason that we use it on futures is because we don't give up much slippage on futures. If I was using it to short-term trade a stock, there's too much slippage I have to give up and too much cost to deal with. So the big advantage of futures are, okay, efficient markets, centrally regulated exchanges, low commissions, virtually 24-hour trading, all electronic trading, and leverage. Trading hours, orders can be entered anytime. Okay. If I wasn't here, I might be trading the Aussie dollar right now. Okay, but stops can work in pit hours or 24 hours a day. Again, you can do it. And again, I'm not advocating anybody trade except during the day trading hours. Now, the actual day trading hours start at 6 Eastern time. Okay, 6 p.m. Eastern is when the new day starts. And that goes all the way until 5 Eastern the next day. Those are day trading hours. Okay, so if you were up in the middle of the night and you were trading, that is considered day trading. Learn from the winners. Okay, it's always better to wish you were in a trade than to wish you were not. Okay, forget what they told you. We want the truth. Follow the money. There's me. That's me in 1987 during the crash on October 19th in the pit of the CBOE. Okay, so what I say to you is learn how to day trade futures. Do something today that your future self will thank you for. And if you'd like to get a hold of me, you can reach me at bubba@bubbatrading.com. I will answer all your questions. And Andy, if you have any questions now, I will take them all.
I do. I have a couple questions from some of the attendees here. Jim from Raleigh, he wants to know if you trade options on futures or just the futures.
Actually, I occasionally trade options on futures if I'm looking for something, but I don't necessarily teach that. Again, when I'm trading futures, I don't want to give up the edge that I'm creating by the futures. The minute I switch to options, that means that more than likely I'm not going to be able to day trade them. I'm going to have to carry them for a longer period of time because of the premium, because of the cost, and a whole bunch of other factors. So I do recommend them occasionally. I do show them occasionally. But as far as pure trading, you can't get any purer than trading the future itself.
Okay. And then Lester from Georgia, he wants to know what kind of account size you would need to get started.
But Andy, I think that would be more a question for you. But I know that 5,000 is probably a reasonable account. That if you've got 1,500 or less day trading margin, 5,000 is probably a reasonable size. Is that acceptable?
Yeah, absolutely. I think that's a rather me say it than you say it. So.
Well, I mean, again, I think that I don't want to put words in your mouth, but I do think that that's the right size. Okay, and again, just in general. I mean, right now, until this crazy volatility, and I don't know if I can say this or not, Natalie, so I'm gonna say it. Just be ready to hit the beep button.
Okay.
Well, no, I mean, when we're doing it right now, our average loss is like $90, okay, and our average winner is like $160. Okay, again, we're not making outrageous claims, but typically, what I'm more concerned about is not the win, but the loss. And the loss, you should regulate that to about $80 to $100, and that should be where your stop should go in, and that's basically how we teach it. That's about where the stop typically goes. So I don't know if that's legit to say or not, but I said it.
Well, we'll let Natalie decide. But Bobo's back from Florida. He wants to know if you use stop losses when you do your trades.
100%. Here, I'll show you real quick right now, just in case this trade would have happened. Okay, so let's say I'm not making this trade right now, but if I would have made this trade, I would be shorting the Aussie dollar right about here, maybe a little bit lower because again I don't know where I would have got in. I didn't make the trade, but my stop here. Okay, so let's say I sold it at 72.48. Okay, the high was 72.50. My stop would be 72.56. Okay, this product trades at $10 a tick, so my risk on this trade is $80. Okay, that's what it is. That's mathematical. It's exactly what it is. We go above or below. If we're buying, we go above the high to put our stop in. If we're buying, we go below the low to put our stop in. Those are automatic. If you don't use those, you're just looking for trouble.
Okay, I think that's good advice. And then one thing you touched on, and I just want to reiterate it, is the day trading rules in the stocks versus the futures. They don't exist for the futures versus the stocks. And I think a lot of people that get started with a small account, they start getting excited in day trading, and they run into the day trading rules in the stock arena. Those don't exist here in the futures markets, right?
No, that's 100%. That's correct, and that's why if you want to be active, okay. Again, we're all investors. I mean, I'm not saying all, but I'm an investor. I'm a swing trader, and I'm a day trader. Okay. But when I want to day trade, I don't want to tie up my money in margin, and I don't want to get those Reg T calls, and I don't want to have to worry about it. When I want to trade, I want to take advantage or take benefit of the market right now. I'm not worried about my long-term investment, okay? So that's why, and of course, again, with the lower margin, remember, if you trade the mini S&P, that equates to 500 shares of the SPY. The SPY is $274, I think, right now. That's $137,000. So you need half of that for overnight margin. Okay, I think maybe you need a quarter of that for day trading margin. But once you sell it, you've got to wait for T plus 3 to Reg T to take over. Versus the future, I can make the same trade with the future. Once I'm done, trade's over, the money's back in my account. I don't have any regulations to worry about.
Right. Okay. Well, I think we've run out of one last one. Somebody's asking how they get in touch with you, so if you could put up your contact information.
I'd be happy to do it. I look forward to it. I want people to get in touch with me.
Yeah, so if you do have any other questions for Bubba, please reach out to him. He's very receptive, very timely on his responses. I've never heard anybody say, hey, he never got back to me. So please reach out to Bubba if you have any questions on anything that we discussed or anything with the world, for that matter, right, Bubba?
Hey, you know me, I got an opinion on everything.
Well, thank you guys, Bubba. That was a great presentation as always. Thank you, Andy. I'm going to go ahead and take the reins back real quickly.
Sure, but boss me around again. Okay.
That's right. It's my turn now to show everyone where they can find your recording. So tomorrow, you guys, if you want to go back over anything Bubba just discussed or just relive the whole wonderful experience again, you can go to avantgardetrading.com, head to the free education page, select November of 2018. That will be available starting tomorrow. And that's where you're going to find Bubba's presentation from this afternoon. So please download it, watch it as many times as you would like. That's what it's here for. So thanks, Bubba, again.
Thanks, everybody.
Always a pleasure.
I look forward to the next one. See you guys.
Sounds great. Thanks, everyone. Have a good night.
Thanks, guys. Bye-bye.